Hey everyone, it's PJ here for Market Update. Today's Monday, the 19th, I think, of October. Yes, it is 19th of October. Hope you've all had a wonderful weekend. Crazy that we're getting so close to the end of October now and the end of the year, but at least we're putting a lot of the bad economic situation that we've experienced over the last 6 months or so, hopefully now behind us and moving towards the time when we're going to get to some greener pastures. So to that end, today's top three things, we're going to start off with a bit of Australia, talk about the RBA and some of the interesting data points that came out in the speech that Philip Lowe, who's the RBA chair, gave on Friday, the 15th. Second thing is going to be volatility, so continuing to watch that and monitor it. We still are in elevated levels. I'll get into that in a moment. And then finally, China. And China's just announced some GDP growth, which is sitting here on your screen. But I'm going to jump first into the RBA and a speech that Philip Lowe gave again on Friday. A lot of interesting data here. And you can, just for your own information, if you want to download this speech, you just go to rba.gov.au. I know you're probably chuckling now as if you would want to read a speech that Philip Lowe has given from the RBA. But I will say, if you're a bit of a policy and economic wonk like me, then some of these things are quite interesting, and they play into a lot of the narratives and the things that I've been talking about over the course of the last few weeks and probably even few months. So a couple of highlights that I just wanted to point out. Before I jump into the charts and things that are in this report, though, again, the RBA in Australia is quite clearly saying, as is the government, that they're going to be very accommodative, very supportive, and doing whatever they can to get this economy out of the doldrums. Now, there's some interesting things here that I'm going to just highlight real quick. Again, you can go and download this report and read it yourself, of course. But there's some interesting things that I think are going to pave the way for that call that we're going to be in in quads, probably quad 1 or 2, sometime in the early-ish part of next year. So looking at the first quarter of next year, which would be the third quarter of our financial year. So that would be probably late Fed, March, somewhere in that vicinity, going into that sort of fourth quarter being April, May, June, to be really looking like we're going to start firing. Anyway, we got a bit to go before then and a few things to see. But first, let's just look at a couple of key charts. So this chart, is showing us that we lost a lot of our jobs in our various industries. And clearly, hospitality got absolutely caned during this crisis. There is no surprise there. People stopped eating out. Didn't stop. They were prevented from eating out, going to hotels, traveling, all that sort of thing. So hospitality clearly got smashed. Interesting to see the professional and manufacturing also took a bit of a hit. But in any case, no surprise there. And of course, public administration, being government, another term for government, actually saw a net increase of employment change since early part of this year. So anyway, that stuff, is interesting, but this is where the bottom part of this table here and seeing some of these categorizations, we really need to see hospitality coming back big time, I think, towards the end of this year. Travel restrictions being lifted, people being allowed to enter the country, and people obviously being allowed to gather in more numbers, etc., and get out there and spend, right? Just get out and spend. Anyway, that was kind of an interesting chart. That one not so much. That one not so much. This is the next one I was looking for, retail sales. So, clearly we've seen a massive fall. This is small firms, right? So this is the small to medium business, and they were already declining. And this is an interesting thing about this chart. As you can see, they were already declining into the beginning part of this year, and just fell off a cliff. Now, luckily, they've bounced back, which is fantastic. But what's going to be interesting on something like retail sales is to see where it goes. And large firms, as you can see, took a bit of a dip, but then had a big spike. It's going to be interesting to see where this goes from here. Is this just a blow-off spike because we were sequestered at home, because we were constricted from what we could do for a long period of time, and the pent-up demand from all of that has just exploded, which is why you see these basically massive spikes in retail sales for both large firms and small firms. Anyway, remains to be seen. Let's see here. Was this yes. This was another one. Now, clearly, Victoria, this is payroll jobs and changes in payroll jobs. Now, obviously, Victoria is going to up through September. We know they were still shut down, still closed, still saying people couldn't move around, business had to be shut. So no surprise there. But we've got to get this. Obviously, all of these regions, we've got to get job creation going again and getting all these numbers back to the positive side. So it looks like these purple dots here were where they were to mid-April, so they've come back quite a bit, which is good. But nevertheless, we still need to see some positive growth there. That would be key. This was another really interesting graph or chart that I had a quick look at, which was the consumption, disposable income, consumption, and savings ratios. So there's a lot of data on this chart, but let's just deconstruct it for a moment. What we've seen is a huge fall off in consumption. This would be why, in large part, our GDP went into the toilet, because consumption, which is a big part of our GDP, just fell off a cliff. Clearly, that's going to be a major input. Disposable income, surprisingly, or maybe not surprisingly, has spiked up. So I suspect the disposable income figure has gone up because people stopped paying their mortgages because they could. They obviously stopped consuming as much because they were forced to. And so that's where you see this big divergence between consumption falling off a cliff and disposable income rising. But finally, this savings ratio percent is just astounding. I mean, it's gone from, as you can clearly see, from 2009 or 2008 there. It's just been on a steady trajectory down, and whammo, it just spikes up massively. I think this whole crisis has scared a lot of people, and it's made them realize that you have to be prepared for a rainy day. And if things like pandemics are going to be coming along now every couple of years or whatever, you need to be prepared for that. So I think it's a good thing that the savings rate has climbed. But this also tells the story of why at the moment we have no inflation. So the parallel I want to draw here, the thing I want to point your attention to, is that when savings ratios increase, it means people aren't spending money. Clearly, you can see from this consumption line here, people aren't spending money. And so we're not going to have a lot of inflation, which the RBA is desperate to get going in the market. Now, what they're trying to do is, and this just tells a bit more of that story. We saw a massive spike early part of 2020 in personal credit card use and so forth. It looks like it was sort of climbing, and then it's just, falling back down into sort of normal ranges. Anyway, just a bit of anecdote there, I suppose. This was another interesting thing, just to tie all this together, and what I'm trying to say about inflation is we've seen interest payments decreasing. So again, whether this is from people going on mortgage pause or not, I guess that remains to be seen. But we've also seen principal payments sort of rising as a flow, and then offset accounts or money held at offset looks like it's risen a little bit as well. So all up, it just looks like people are paying off their mortgages with the extra money that's come through or whatever. Again, doing that is not going to drive inflation, and it's also not going to drive GDP. So I suspect what the RBA, one of the things they're wanting people to do is get out and spend money in this economy, and the government's trying to fire that up. But what will be curious, I guess, with this data going forward is to see whether or not the offset thing shrinks, the principal amount shrinks, and the interest component maybe rises or just stays flat. That should tell us a bit more about consumption. I don't think there was anything else from this report. This is the final thing I think I want to show you from this report. Clearly Australia, in terms of debt as a percentage of GDP, we are in the absolute sweet spot right now. We're very low, compared to other countries like Japan, which is just almost off the chart there, and the U.S. even though the U.S. isn't as bad as Japan, but they're headed that way. We're in a great spot. And I've been saying this now in the last few updates I've made. The Australian government has done the right thing with this budget. They are trying to promote economic growth by putting money into the economy, by spending the public purse and going into more debt and deficit spending. That is a good thing, and it's going to benefit us over the long term. So that was just a little bit of a run around the wood there to talk about some of the data points and some of the things that I've picked out of this report from the RBA. And again, it's going to support the narrative and the likelihood of us getting into one of the growth quads, which would be quad 1 or 2, in the first half of 2021. So again, once we get past some of these other things like market volatility and some other stuff going on right now, and the election would be another big one, we should see the way paved for that stuff to happen. So point number 2 was the VIX. I'm just going to drop over to Interactive Brokers. So for those of you, I probably haven't mentioned this, but this is the Interactive Brokers screen. It's the one I've got set up. I've got some stuff turned off so that it doesn't accidentally ping any sensitive information. But one of the things I just want to, again, bring your attention to are these 2 volatility indexes, VIX, which is the volatility of the S&P 500, and VIXN, which is the volatility of the NASDAQ. Now, some of the critical levels that we have to watch for here. First of all, we're above 21 on the VIX. Now, typically that's going to signal a bit of caution. Now, we're also above 25, which really signals a red flag, which is be very, very careful about this market. And that's exactly what I've been doing, is maintaining a high amount of cash right at this point, this juncture, and being very careful, because we are now getting to some elevated levels, which, again, because of that volatility not coming out of the market, it signals that something bad could happen. Now, I'm not saying it's going to. I have alluded to the fact in the past that October, we got a lot of crashes that happened in October. October is not over yet, and volatility is elevated. So, there's just a couple things there that are saying to me we've got to be super cautious. The VIX, the VXN, or the NASDAQ volatility, again, we want to see this get down below 30, really, to be comfortable and confident around deploying a lot of capital back into growth sectors like technology stocks. Until such time as that VIXN comes down, I'm going to be exceptionally cautious about deploying any money towards those markets. Now, there's a lot of other volatility metrics I have on here, but those are the 2 main ones that I keep an eye on. So I just want to remind you that volatility has not gone away. The market is doing what the market does, which is probably sucking in a lot of people right now to eventually hand them their head, because they don't understand. The retail investor doesn't really understand volatility and how absolutely dangerous it can be. So for me, I'm deciding here to be much more cautious on the markets and the volatility. We'll see how this week unfolds. I do think that we're going to see continued volatility as we head towards the U.S. election, and it might get even worse as well as we get closer to it. I mean, who knows what's going to happen? So we're not long for that now. Finally, China. So, whoopsie, I want to come back to this one. So China posted some reasonably good numbers on GDP. Now, again, most people know that China kind of makes up these numbers, but whatever. Anyway, it's the number they reported. And I just want to go back to one other, where was it? Did I delete it? No, here we go. I just want to go back to a chart that I've shown you before. And this is compliments of my good friends at Hedgeye. I just want to remind you where we're sort of looking at in terms of quads. Now, just draw your attention here to China. So in Q3, which is what they've just reported, Hedgeye was calling for about almost 4% GDP growth. So that was 3.9. So clearly they have, if you look at this this headline, they did almost 5% in Q3. So that's going to be, and I've mentioned this before about China being out of the poo and moving quite strongly, as you can see here, quad 2 for this third quarter, and then bumping into consecutive quad 1 in the fourth quarter, and then the first quarter of next year. I'm not too concerned about looking too far out into the future, because obviously this data can and will change. But for the time being, China is going to be a big driver of what's going on out there in sort of certainly the global economy, but definitely in the region, which is our Asia Pacific region. Furthermore, if you look at some of the other Asian countries that are doing or looking like they're going to be doing okay, India is showing some steady, strong quad 1s. Indonesia, similar. Thailand's not on here. There's a couple of other emerging markets that are also looking pretty strong going forward. So anyway, the point I'm trying to make, which I have mentioned before is that emerging markets are looking like they're recovering nicely, and I think that's going to bode well for Australia, which of course we've got sort of a quad two call on for the moment. But fourth quarter GDP estimates are looking like they might be a little bit lower than what they were previously. Anyway, we're going to have to wait and see on that. I think that's going to be a function of the fact that we went through the COVID crash, we had the economy reopen. Now we've got what happens next, which is as businesses open again, as we find out what happens when the government stimulus falls off, so JobKeeper and all these things, people have to start paying the mortgages again. So apparently I saw a statistic over the weekend that something like 50% now of the mortgages that had been put on hold are back to being required to be paid. So we're halfway to being where we were pre-COVID with people having to pay their mortgage. But we're not halfway back to the employment levels that we were at pre-COVID. Hopefully that made sense, what I just said there. So in other words, are we set up now for a situation where people's lives in terms of their commitments to mortgages and that sort of thing are going back to sort of normal, but they're not back to normal because they're not back to full employment, or maybe they've still lost their job, or their business hasn't been able to reopen, that sort of thing. So I think to summarize all of that, there is still a fair amount of caution that I am approaching the market with. Now, having said that, and one other thing I'll just touch on is the US dollar versus some of the other currencies. So the Aussie dollar has been, see if I can get this on the screen here, has been fairly weak since August. As you can see, in August, it popped up to almost 74. Well, intraday, it went up to 74. And then it's kind of just steadily sold off back into, the somewhere between 70 and 71 cents in that range. And I'm very curious as to where the Aussie goes from here. It's just going to be one of those interesting things because we're such a strongly commodity-based economy. One of the other key metrics, actually, I do have this chart. Sorry, I was going to show this to you to remind you of the relationship between the US dollar and all this other stuff. So again, other than volatility, which I'm watching closely, the other relationship, which I often talk about probably every single time I do an update, is the US dollar inverse correlations. And as you can see over a 90-day period here, it's still quite strong against gold, the commodities, and the S&P. In the short term, it's a little bit less close, but nevertheless, still, some fairly high correlations there still exist. So the US dollar is still one of those things that has to be paid attention to. Yes, it is in a bear market, and it's likely that the US dollar is going much, much lower over time. But for the moment, in the shorter term, and even in sort of this intermediate term here, it is showing, it's demonstrating that when it has strength, everything else has weakness. So things like gold, oil, the S&P 500, and commodities all have that inverse correlation such that when the dollar goes up, those things tend to go down. And we've seen some continued weakness in the commodity markets in things like coffee and sugar and cotton and soybeans and wheat and corn and all that stuff, hogs, cattle, etc., lumber, all those things which were doing very well about a month ago have started to, or have sold off. And again, we'll be watching to see what this correlation does. And how it changes over that period over the next little period of time to see whether we're going to be back into quad 3 in the US or what's going to be happening with the dollar. So anyway, I'm not going to beat that broken record anymore. You know where I stand on that. Very, very important to know where the dollar's going and what it's doing and that correlation. So anyway, that is a bit of a run around the wood today. Again, hopefully, this U.S. election cycle isn't going to cause too much drama. We can have a smooth transition of power if that's what the issue is, if Biden wins. And then, of course, hopefully we'll get back to good, solid economic growth happening in Australia and other parts of the world and be able to invest accordingly. So anyway, not a whole lot, as you can see, to really report for now, except to highlight volatility still elevated, U.S. dollar still highly inversely correlated to a number of things. And right now, probably being defensive, holding U.S. treasuries, starting to dabble in a few Australian equities and things, but being very careful there. but getting exposure to Asia. This is the next move for me, is to position some portfolios by taking positions in Asian equities and stuff that relates to Asia, and making money there, generating some alpha there. Anyway, guys, have a fantastic week. Hope you are all well, and I will leave another update very soon. Cheers. Bye.